Welcome back to the Violet Vault. You know, it is just wild out there in the markets right now. You've got AI stocks going to the moon. You've got meme stocks making a comeback. It's so easy to feel like you're just getting tossed around in the waves. But what if I told you there's a compass, a set of powerful, time-tested ideas that can help you steer the ship through all of this chaos? Well, that's exactly what we're going to dive into today. So I was scrolling through Reddit the other day, and I stumbled on this comment in a discussion about investing. And it just stopped me in my tracks. It perfectly captures this feeling that no matter how much technology changes, the fundamental game stays the same. The emotions that drive the market, fear and greed, they haven't gone anywhere. But is that really true? Is this time really not different? Let's find out. And that really gets to the heart of the matter for so many of us, right? It feels like a casino out there sometimes. You've got people hitting jackpots, and you've got people losing their shirts. So how do you participate? How do you build long-term wealth without getting totally burned by the short-term craziness? Well, believe it or not, there's a surprisingly simple framework that can cut through all that noise. Our guide on this journey is a true legend, a guy named Benjamin Graham. Now, if that name sounds familiar, it should. He was Warren Buffett's mentor, the man who literally wrote the book on value investing. And after getting wiped out in the crash of 1929, he dedicated his life to figuring out a better way. He came up with one simple golden rule that draws a line in the sand, a rule that honestly can clarify every single financial decision you ever make. Okay, so here it is, Graham's definition of what an investment truly is. Now, this may look a little academic, but let's break it down. It has three key parts. First, thorough analysis. That just means you've actually done your homework. You understand the business you're buying into. Second, safety of principle. This is huge. It means you have a good reason to believe you won't lose your initial capital. And third, an adequate return. Notice he didn't say a get-rich-quick return, just a solid, fair profit for the risk you're taking. And this is where the light bulb really goes on. Graham said if what you're doing doesn't meet all three of those criteria, it's not a bad investment, it's just not an investment at all. It's something else entirely. It's speculation. And look, he wasn't saying speculation is evil or that you should never do it. He just insisted that you have to be brutally honest with yourself about which game you're playing. Are you investing or are you speculating? So this brings us to the two mindsets. The investor asks, what is this business really worth? Is it a healthy, profitable company? They're buying a piece of a business. The speculator, on the other hand, is just focused on that little ticker symbol going up and down. They're watching price charts, they're following the hype, they're betting on which way the crowd is going to run next. So take a second and just ask yourself, honestly, which mindset have you been in lately? Now, to help us all stay in that investor mindset and ignore all the speculative noise, Graham gave us what I think is one of the most brilliant and useful stories in all of finance. He actually personified the stock market, turning it into this unforgettable character. Let's meet him. So here's the story. Imagine you're in business with a partner named Mr. Market. And this guy, he's a bit of a mess emotionally. Some days, he shows up to the office bouncing off the walls, totally euphoric. He sees nothing but blue skies ahead and offers to buy your shares from you at ridiculously high prices. But then other days, he comes in convinced the world is ending. He's totally depressed, and he offers to sell you his shares for pennies on the dollar. He's irrational, he's emotional, and he shows up every single day to shout a new price at you. You think that's an exaggeration? Let's look at Mr. Market in the real world. Back at the peak of the dot-com bubble in the year 2000, he was absolutely manic about a company called Cisco's Systems. He was so giddy, so optimistic, that he valued the company at nearly $600 billion. Then, the mood changed. Just 2 years later, Mr. Market was in a deep depression. He was now willing to sell you that very same company for just $60 billion. That's a 90% drop. Now, had the business fundamentally changed by 90%? Of course not. Only Mr. Market's opinion had changed, and that is the absolute key. His daily price is just an opinion, often a crazy one. It's not a fact. And this famous quote from Graham's student, Warren Buffett, just sums it up perfectly. In the short run, the market is a popularity contest, a voting machine. It's all about sentiment, hype, fear, and greed. But in the long run, reality always wins. The market has to recognize the actual weight, the actual substance and value of a business. It becomes a weighing machine. The intelligent investor's job is to use Mr. Market's mood swings, not be used by them.
Okay, so this is all great. We know we shouldn't trust Mr. Market's daily moods, and we know the future is fundamentally unknowable. So how do we actually protect ourselves from all that uncertainty? Well, Graham gave us a practical tool for that too. In fact, he called it the central concept of investment.
It's called the margin of safety, and it's really just a beautiful, simple idea. It's a buffer for being wrong. It's your financial seatbelt. It's admitting, hey, I'm not a fortune teller. I don't know what's going to happen next year, so I need to build in some room for error. It's basically a fudge factor you build into every decision to protect yourself from bad luck or, one of Mr. Market's classic mood swings. And the logic behind it is actually a really simple 3-step process. Step 1, you do the homework to figure out what you think a business is actually worth, its intrinsic value. Step 2, you wait patiently until Mr. Market gets depressed and offers to sell you that business for a price that is way below your calculation. Step 3, that huge gap between the price you paid and the value you calculated, that's it. That's your margin of safety. That's your shield.
All right, I know what some of you are probably thinking. This all sounds really nice and logical, but Ben Graham was writing this stuff almost 100 years ago. Does any of it actually work today? I mean, we live in a world of crypto, AI, and high-frequency trading. Is this stuff just old news? It's a fair question.
You see, Graham's approach wasn't just some vague philosophy. He gave his followers a literal checklist. He had these 7 criteria for finding what he called a defensive investment, one that could protect you. He looked for things like being big enough to survive a downturn, having a strong balance sheet, a long history of paying dividends, and, of course, not paying a crazy price. He wasn't trying to find the next lottery ticket. He was trying to find stable, resilient businesses that could weather any storm.
Now, the critics, they've got some pretty strong arguments. They'll say, look, the game is different now. You have giant index funds that have to buy stocks no matter what the price is. You have the so-called Fed put, this idea that central banks will just never let the market crash. And of course, you have retail meme cults that can keep a stock flying high on nothing but vibes for years. And yeah, all those things can definitely make it feel like value investing is dead.
But, and this is the really big but, here's the thing that hasn't changed one bit: human psychology. Technology changes, companies change, but people don't. The fear and greed that drive Mr. Market are absolutely timeless. For example, when Mr. Market panicked because a star designer left Gucci's parent company Kering, smart investors saw a chance to buy a whole collection of amazing brands at a discount. Or just last year, in 2023, when everyone was freaking out about regional banks. That was a classic Mr. Market panic attack, and it created huge opportunities. The opportunities are still there because human emotion is still there.
So really, at the end of the day, it all boils down to this one question, a choice that you have to make over and over again. Real investing isn't about being the smartest person in the room. It's about having the discipline and the emotional control to ignore the crowd. So, what's it going to be? Are you going to listen to the manic, bipolar shouts of Mr. Market, or are you going to trust the quiet confidence of your own homework? The choice is always yours. Let me know in the comments, what's the first step you're going to take after watching this?
Wow, that was something, right? But don't go anywhere, there's more coming, and it's going to make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Hey everyone, and welcome back to The Vault. Today, we're doing something really special. We're not talking about hot stock tips or the latest crypto craze. Nope. We are going to crack open the master plan from investing's greatest duo, Warren Buffett and Charlie Munger. Our goal is to decode their timeless wisdom so that you can walk away from this with a plan to build your very own financial blueprint.
All right, let's kick things off with this absolute gem from the late, great Charlie Munger. What's he really saying here? He's telling us that you can't just borrow someone else's conviction. You can't just watch a video and say, okay, I get it now. True wisdom, the kind that actually sticks with you through thick and thin, has to be earned. You've got to wrestle with the ideas yourself, and that's exactly what we're going to do today.
You know, the unbelievable success of Berkshire Hathaway, that wasn't an accident. It wasn't luck. It was the result of a clear, disciplined, and repeatable philosophy. Think of it like a blueprint, built piece by piece over decades of trial and error. Today, we're going to learn how to read that blueprint, and we're starting with the foundation, the most important part of all, your own mind.
So, Section 1, the psychology of winning. And I mean this quite literally. It is all in your head.
Before you even think about looking at a single stock chart or reading an annual report, the real game is won or lost right between your ears. Your mindset is everything. It controls your strategy, it dictates your patience, and ultimately it determines your results.
This right here, this is the fundamental choice every single one of us has to make. You have to ask yourself, which one am I? Are you the speculator on the left, glued to your screen watching prices flicker up and down trying to guess what the crowd will do tomorrow? Or are you the owner on the right, thinking about the actual business you're buying a piece of, its long-term health, its real value? It's no secret which path Buffett and Munger took. Their entire empire was built on that owner's mindset.
Okay, so that is the billion-dollar question, isn't it? How do you actually make that shift and start thinking like a business owner? Well, let me tell you, it's not about having a crystal ball or trying to predict the future. It's about having a framework, a mental checklist that guides your decisions and keeps you grounded when the market inevitably goes crazy.
And that brings us right to our next section, a 4-filter framework. I love this subtitle, a simple, not easy method. Charlie Munger was an absolute master at taking decades of experience and boiling it down to its core essence. And that's what we have here, 4 simple, common-sense filters. They're simple to understand, for sure, but putting them into practice consistently, well, that's the not easy part.
And here they are. This is the heart of it all. It's not some crazy algorithm, right? It's just a checklist for thinking clearly. 1. Can I understand this business? 2. Does it have a durable competitive advantage, a lasting edge? 3. Are the people running it both capable and honest? And 4, and this is crucial, is the price I'm paying sensible? That's what this is all about. Creating a margin of safety for yourself. Answering these 4 questions honestly. That's the work.
Let's just zoom in on that second filter for a minute. Buffett's famous term for this is a moat, like the water around a medieval castle. It's what protects the castle, the business, from invaders, from competitors trying to come in and steal the profits. A moat could be a powerful brand like Coca-Cola has. Or in the modern world, think about the data advantage that a company like Google has. It's a moat so wide and so deep that it's almost impossible for anyone to compete. Without a moat, a company's success is always temporary.
Now for filter number 3, finding able and trustworthy management. This is so much more than just looking at a CEO's resume. For Buffett, it's all about character. And there's really no better way to understand what he means by that than by looking at a real story from one of his all-time favorite deals.
So the story goes like this. In 2005, Buffett gets a letter about an RV company called Forest River. Just 1 week later, he's sitting down with the founder, a guy named Pete Leigel. Now, a deal this big would normally take months, with teams of lawyers going back and forth. But not this one. They agreed on a price in minutes. It was all done on a handshake based on mutual trust. But the most amazing part was yet to come.
When Buffett asked Pete what he wanted his salary to be to stay on and run the company, this is what he said. Just think about that for a second. The man just sold his business for a fortune, and that's his salary request. He valued being part of the Berkshire family more than he valued squeezing every last dollar for himself. That single sentence told Buffett everything he needed to know about the man's character. That is trustworthy management.
Okay, let's move on. Mistakes, winners, and patience. This is where we talk about the reality of investing. Because even with the perfect framework, even with management you trust with your life, you are going to make mistakes. Things will go wrong. Investing is not about being perfect. The real secret is understanding the massive difference between how your winners and your losers behave over time. I mean, just look at this. Most CEOs avoid the word mistake like the plague. It's all about projecting perfection. But Warren Buffett, just in his last 5 annual letters to shareholders, has openly used the words mistake or error 16 times. He isn't ashamed of his mistakes. He learns from them, and he knows they're just part of the process. And this slide explains exactly why he's so comfortable admitting errors. Your mistakes, your bad calls, they fade away. They become footnotes. You can only lose 100% of what you put in. But your winners, your winners can blossom forever. A single great company bought at the right price can compound for decades and grow to a size that completely overshadows every mistake you've ever made, combined.
And trust me, the journey will have some absolutely incredible highs. Just take a look at 1985. In that one single year, the value of Berkshire Hathaway grew by almost 94%. That is the incredible power of a winner that's really starting to take off.
But, and this is a huge but, you have to be psychologically prepared for the gut-wrenching lows. In the depths of the 2008 financial crisis, Berkshire's value fell by nearly 32%. This is the real test. If you can't stomach a drop like that without panicking and selling, the framework won't save you.
Patience isn't just a nice little virtue in investing, it is an absolute requirement.
So how do we tie all this together into something practical you can start using today? Let's distill all this incredible wisdom down into a set of key takeaways for your own investor's blueprint.
Here they are. First, you have to think for yourself. Don't follow the herd. Second, stay inside what Charlie Munger called your circle of competence. If you don't understand it, just stay away. Next, and this is so important, acknowledge what you don't know. Humility is a superpower in this game. And maybe the hardest one of all, learn to sit still. Resist that little voice in your head that's always telling you to do something. Often the best move is no move at all.
When you strip away all the noise, all the complex charts and fancy jargon, investing boils down to this one simple, beautiful idea. You're not buying a ticker symbol. You're buying a piece of a real business. Your job is to find a good one and then wait patiently for the day the market gets scared and offers it to you at a bargain price. That's it. That's the whole game.
And that leaves us with one final thought I want you to take with you. To truly adopt this owner's mindset and to start building your own blueprint, you often have to unlearn something first. So my question to you is this: what's the one long-held belief you have about money or investing that you need to challenge, or maybe even let go of, starting today? Let me know down in the comments. I'd love to hear what you think.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Hey, welcome to the Violet Vault. If you've ever felt like building wealth is just way too complicated, or that you have to be some kind of Wall Street genius to figure it out, then this one's for you. Today, we're going to cut through all that noise. We're taking the timeless wisdom of an investing legend, Benjamin Graham, and combining it with a brilliantly simple plan from J.L. Collins to give you one clear, powerful path to financial freedom.
This right here. This is the whole reason we're talking about this today. This was said by investor J.L. Collins' daughter, and man, does it hit home. It perfectly captures how so many of us feel, right? We know this money stuff is important. We get it. But the whole world of investing, it just feels so complex, so intimidating, and honestly like this massive chore we'd rather just avoid.
But what if there was a path designed specifically for the reluctant investor? That's exactly what we're going to map out. We're going to look at two incredible mentors who offer a clear plan and, just as importantly, a powerful mindset to solve this exact problem.
So on one hand, we've got our modern guide, J.L. Collins. This is a guy who literally wrote The Simple Path to Wealth for his daughter who wanted nothing to do with managing money. And on the other hand, we have the timeless philosopher, Benjamin Graham, the father of value investing and the guy who literally taught Warren Buffett. Collins gives us the what to do, and Graham gives us the how to think. And trust me, you need both.
All right, let's dive into the plan itself. This is the gift from our first mentor, J.L. Collins. It's a strategy so simple, it almost feels like you're cheating. It's designed for you to set it up and then, well, get on with your life.
Collins' whole philosophy boils down to just a few powerful ideas. And it all starts with the single most important financial habit you will ever build: paying yourself first. Before you pay your rent, before you buy groceries, before a single bill gets paid, a portion of every dollar you earn goes straight to your future self. It's non-negotiable.
Now, he suggests a pretty ambitious target, 50%. And I know what you're thinking. Whoa, 50%? Why so high? Well, because as he says, the single most valuable thing your money can ever buy is your own financial freedom. Every dollar you save isn't just a dollar, it's a piece of your future life that you are buying back. Okay, so where does all this money you're saving go? This is the beautiful, simple core of his entire investment plan. He says, put it all into one thing: the Vanguard Total Stock Market Index Fund, or VTSAX. That's it. Seriously, no picking stocks, no trying to time the market, just buy this one fund.
So why this one fund? What's the magic here? Well, it's not magic, it's just really smart. First, it has incredibly low costs, so sneaky fees aren't eating away at your returns. Second, you instantly own a tiny piece of the entire US stock market. Talk about diversification. Third, you're invested in stocks which historically have provided the best returns over the long haul. And finally, with a company like Vanguard, their interests are actually aligned with yours, which is a huge deal.
Now, look, having a simple plan is fantastic, but to actually stick with it when the market gets scary and the news is screaming sell, you need the right mindset. And that's where our second mentor, the great Benjamin Graham, comes in. He teaches us why this simple path is so powerful, because he teaches us how to think like a real investor. You know, Graham's most famous student, Warren Buffett, said it best. Success in investing isn't about being a rocket scientist. It's about having a solid intellectual framework, a set of rules, and, this is the crucial part, having the emotional discipline to not throw those rules out the window when you get scared. That framework. That's Graham's gift to us.
And Graham starts with this really important question. Are you an investor or are you a speculator? An investor is like a business owner. They analyze the real business, they prioritize safety. A speculator? They're just a price guesser, betting on which way the squiggly lines on a chart will go. Collins's simple plan automatically puts you firmly in the investor camp.
This brings us to Graham's single most important idea, the margin of safety. Don't let the fancy name fool you. It's a simple concept. It's just a buffer between the price you pay for something and what it's actually worth. Think of it like this. It's the safety net that protects you from bad luck, from your own mistakes, and from the crazy, unpredictable chaos of the market.
So, to help us master our emotions and actually use that margin of safety, Graham gives us this brilliant little story. He asks us to imagine that we have a business partner, and his name is Mr. Market. Here's the thing about your new partner, Mr. Market. He's a little unstable. He shows up at your door every single day, without fail, and offers to either buy your shares from you or sell you his. But his mood swings are wild. Some days he's euphoric, totally optimistic about the future. And other days, he is panicked, terrified, and full of despair. But here's the secret. His emotional instability is your greatest advantage. When he shows up euphoric and offers you a ridiculously high price for your assets, that might be a good time to sell. And when he shows up panicked, willing to sell you his stuff for pennies on the dollar, well, that's your time to buy. And here it is. This is the key to the whole thing. You are never, ever forced to trade with him. You can just shut the door. The intelligent investor understands that Mr. Market is there to serve you, not to guide you. Most of the time, the absolute smartest thing you can do is form your own opinion of what your investments are worth and just completely ignore his daily emotional chatter. So how do these two big ideas connect? J.L. Collins's simple plan and Benjamin Graham's timeless mindset. Well, this is where it all clicks into place. We can now see that Collins's practical, simple plan is actually the ultimate, modern expression of Graham's timeless wisdom. And this is the ultimate takeaway. Following the simple plan of just buying a fund like VTSAX over and over, that is your margin of safety. How? Well, the broad diversification protects you if any one company goes bust. The super low cost protects you from the death by 1,000 cuts of high fees. Investing systematically means you automatically buy more shares when prices are low, when Mr. Market is having a panic attack. And its beautiful simplicity, that's what protects you from your own worst enemy, your emotional urge to do the exact wrong thing at the exact wrong time.
See? You don't need to be a genius. You don't need secret information. Thanks to our two mentors, we have a simple map from J.L. Collins and an unshakable mindset from Benjamin Graham. When you put those two things together, you have absolutely everything you need to build wealth successfully over a lifetime.
So I want to leave you with a question. What's the biggest obstacle, the one thing that's preventing you from taking that first simple step? Is it fear? Is it confusion? Is it just inertia? Be honest with yourself, because figuring out the answer to that question, that is the very first move you can make toward achieving your own financial freedom. Let me know what you think in the comments. I'd love to hear from you.
Thank you for spending time with us here at the Violet Vault. Don't forget to like, subscribe, and drop your thoughts in the comments below. I'd love to hear from you. Until next time, stay focused and keep growing.